All right, let's jump right in with a question that seems super simple on the surface, but actually, it's a huge deal. It's a question that quietly shapes our entire economy, dictating how trillions of dollars get invested and what our biggest companies focus on every single day. So let's get right to it. Just think about any company out there. Doesn't matter if it's your local coffee shop or a massive global tech firm. Who is its ultimate master? I mean, who really calls the shots? And maybe more importantly, who gets all the rewards when things go great? For decades, the answer to this was a no-brainer. The company works for its shareholders, period. Their job is to own a piece of the business, and the company's job is to make that piece as valuable as it can possibly be. Simple, right? Well, not quite. And this is where things start to get a little tricky the second you ask a really basic question. Where does all the money come from? Because here's the thing, it's not just the owners putting up the cash. Companies are also funded by lenders. And these two groups, they're in this constant, quiet battle over the company's future. So first up, you've got equity. The best way to think about this is as the high-risk, high-reward owner's slice of the pie. When you buy a share, you're buying a piece of all the company's future profits, whatever they might end up being. And the company, it never, ever has to pay you back for that initial investment. And then you've got debt. This is the lender slice. Now, this is the much safer play. Lenders are giving the company money that has to be paid back with interest. If the company has cash coming in, the lenders get paid first, before the owners see a single dime. But what's the trade-off? Their potential reward is totally capped. And if you look at them side by side, you can really see where the tension comes from. People who hold debt have a legal right to get their money back. It's a priority claim. The equity holders, they just get what's left over, the scraps. But in exchange for taking on all that risk, equity holders get two incredibly important things: voting rights and the chance for an absolutely unlimited return. And this is the key takeaway, right? If a company invents the next big thing and its stock goes to the moon, the shareholders get to ride that rocket all the way up. Their potential upside is, in theory, completely limitless. But what about the debt holders, the lenders? They don't get anything extra. They just get their loan paid back with the interest they agreed to at the beginning. Their reward is totally fixed, no matter how wildly successful the company becomes. And that, right there, is why shareholders are often huge fans of taking on debt. It's a concept called leverage. Basically, using other people's money to juice your own returns. I mean, as you can see in this example, it can literally double the profits for owners. But you have to remember it's a double-edged sword. If things go bad, those debt payments don't stop, and they can sink the entire ship. Okay, so we've got this tug-of-war between owners and lenders. But honestly, that's just the beginning of the story. To really get the full picture, we need to zoom out. Because a company's success, or its failure, doesn't just hit the people who provide the cash. It affects a much, much wider group of people we call stakeholders. This is the company's real ecosystem. You've got to look way beyond just the investors. You've got the employees who are building their entire careers there, the customers who depend on its products, and even the communities and governments that are affected by its very presence. They all have a stake in the game. And this, right here, brings us to one of the biggest debates in the modern business world. On one side, you have shareholder theory, which says the one and only goal is to make more money for the owners. That's it. But on the other side, you have stakeholder theory, which argues that no, a company has a much broader duty to everyone in that entire ecosystem. And what's so fascinating is that even Milton Friedman, who was the biggest champion of the shareholders first idea, saw the gray area here. He basically argued that taking care of your community and your employees isn't just about being nice. It can actually be a really smart, long-term business strategy to attract the best talent and ultimately make even more money. So that's the big idea, but how do you actually put this into practice? How do you measure these bigger responsibilities? Well, today, the go-to answer is a little three-letter acronym, ESG. So what is ESG? Well, it stands for environmental, social, and governance. It's a way to judge a company not just on its balance sheet, but on its total impact on the world. E is all about its effect on the planet. S is about how it treats people. And G takes a hard look at how the company is actually managed on the inside. And look, this isn't just some vague feel-good concept. We're talking about real, measurable things. For environmental, that could be a company's climate policy or how it handles waste. For social, it's stuff like data privacy and labor standards.
And for governance, it's about the makeup of the board and how much executives get paid.
And let me tell you, when companies get this stuff wrong, the fallout can be massive. The costs are very, very real. Let's look at a few quick examples, starting with a huge environmental failure. Okay, so back in 2019, a dam at a mine in Brazil, owned by a company called Vale, just collapsed. It unleashed this horrifying wave of toxic mud that tragically took 270 lives and completely destroyed the local environment. And the price tag for this disaster? Vale eventually had to agree to a settlement of $7 billion for compensation and repairs. A staggering price to pay for failing to manage that environmental risk. All right, let's switch gears to a social failure. You probably remember this one. Facebook was found to have shared the personal data of over 80 million of its users with another company, all without anyone's consent. So what happened? The US government hit them with a record-breaking $5 billion fine. It's a perfect example of how mishandling your social responsibility, in this case user data, can hit your bottom line hard. And for our last one, let's look at a failure in governance. The German industrial giant Siemens was caught with a massive systemic bribery scheme. We're talking over €1 billion paid out just to win contracts around the world. It was a complete and total failure of their internal controls. All of which brings us right back to where we started. When a company's failure to protect the environment or its own customers or even its own integrity can lead to these multi-billion-dollar penalties, well, it really suggests that caring for all stakeholders isn't just a nice thing to do. It might be essential for survival. So is the whole purpose of a company changing right before our eyes? Is it shifting away from just serving shareholders to serving everyone? That right there is the question that's defining the future of business.